Thank you for joining us at XM.com. You're watching today's market comment by Mario Sajikiriakos. I'm Christina Marujos. It was a wild trading session for global markets on Thursday in the aftermath of the U.S. inflation data. The CPI report itself was slightly cooler than expected, with both the headline and core rates coming in slightly below forecasts in yearly terms at 3.2 and 4.7% respectively. In the markets, the initial reaction was precisely what one would expect from a cold CPI reading. The dollar and yields fell, while equities and gold rose. But most of these assets quickly erased their post-CPI moves to trade in the opposite direction as the bond market gained control. Once the dust settled, U.S. yields powered higher, sapping stocks and boosting the dollar in the process. This reversal likely reflects the recent shift in demand-supply dynamics in the U.S. bond market. Amid runaway government deficits and the Treasury increasing its debt issuance, both in size and duration, the balance of power seems to be shifting in favor of higher yields. A soft 30-year Treasury auction certainly reinforced this notion yesterday. In the FX arena, rising yields translated into a boost for the US dollar through the interest rate differential channel. The world's reserve currency erased some of the early losses to close higher against most of its major counterparts, even despite the CPI miss, which is very encouraging. It is clear by now that the U.S. economy is superior to its competitors. The Atlanta Fed GDP Now model is tracking economic growth near 4% this quarter, whereas business surveys suggest the Eurozone is teetering on the verge of recession and China is losing steam. Therefore, this economic divergence might eventually be reflected in the FX market through a stronger dollar, especially now that increased bond supply is putting upward pressure on U.S. yields. With Japanese yields being among the lowest in the world and soaring energy prices dimming the outlook for oil importing currencies, the yen continues to suffer. Dollar-yen sliced above the 144 level yesterday, the region where Japanese authorities decided to defend last year via FX intervention. However, the absence of any worried comments about exchange rates implies that the bar for another round of intervention is much higher now, which effectively gives speculators free rein to keep hammering the yen. When yields march higher, they essentially exert a gravitational pull on most assets. Higher yields incentivize investors to park their cash in the safety of bonds and therefore decreases demand for risky plays like equities or non-yielding assets like gold. This helps to explain why both stocks and gold erased their intraday gains yesterday to close virtually unchanged. Thank you for watching today's market comment here at XM.com. Have a great weekend.